It is 11 o'clock. Let's get started. So today, our guest speaker hasn't arrived, and what you know me, right? I'm gonna keep moving, and it's Central Time, Pacific. Pacific. So that'll be 12 o'clock my time. That's when we would end. We would normally end that time. Yeah. Okay, great. So so the original guest wasn't able to make it, but we have someone in this room who has years of experience in capital raising. And if he's capital raising, I know he knows how to underwrite. He's been on many shows, many podcasts. Matter of fact, he has even been he's been on Alicia's show, and he's been on when we had the capital raise strategy session. He he's even been on that show. So who am I talking about? Who am I talking about? I'm talking about the one and only Mr. Chris DeSell. That's what I'm talking about. Chris, thank you very much for being a guest today. Because I was going to reach out to you anyway. So I'm glad I was able to get you to. I'm glad you agreed to step in because because I wanted to have a guest today. So, but tell everybody a little bit about yourself, about how you got started in the commercial realm, and let's take it from there on and discuss my love underwriting.
Sure thing, Darryl. Thanks so much for having me. I appreciate it. So we buy distressed apartments and do the value add strategy, about 100 units or more. And when I started, I was going to do a single family house, and then that didn't really work out. And then I was going to do a fourplex over by USC, and I was going to buy it for 1.2 million. I have to put 800K into it, live in one of the units, and then rent out the other three. And I went to a real estate meetup, uh, and there was a gentleman there who told me I was crazy to do that. So, and I'm like, yeah, why? He goes, it's too risky. He goes, if you just do the math, then and it'll work out. So I'm like, what? He goes, well, why don't you? I can show you. So over 7 months, we met like 40 times. And
Mm,
basically, he took my underwriting template and it just helped me to uh, mitigate my risks and pass stress tests a lot more by going bigger. So um,
great,
that's the way I started back in
great.
2011. So
So this is what I'm going to do. I want I'm a let, we're going to tag team this and we're going to do a double joint. What does that mean? That means we're going to have. I'm not going to end with Chris. Dion is here, so we're going to move forward with. And we're going to do. I'm going to do a joint. I hope Chris and Dion doesn't mind if we do a joint talking about underwriting. Talking about underwriting. That's what we're about. We are the commercial multifamily underwriting show, and we're going to stick to the underwriting. So, what I would normally read, my intro, but I'm going to go ahead and I would like for Dion to please introduce himself and tell everybody a little bit about you and how you got started. You're on mute.
Yeah, hey, trying to see if I can get on my phone because I've got a clearer mic.
Are
Uh,
you sound good. You're perfect.
you can hear me all right?
Yeah, perfect.
Okay, great, awesome. All right, then I'll just do that then. I'll stick with that. Well, I appreciate you inviting me on here. And happy to spend this time with everyone else here on the call. My name's Dion, and I've known Daryl. We've known each other for what, like 3 years now, I think it's
Yeah,
been.
yeah.
Yeah, through the GOB network. And we've had the opportunity to work together on projects with the GOB and everything. And as far as my background, I mean, I've done quite a few things. A lot of it real estate on the brokerage side. So I worked in real estate in three very different markets in Boston, Massachusetts, in Columbus, Ohio, and in New York City. And now I'm actually on my fourth market, Pittsburgh now. So, but in three very distinct markets. Um, a lot of the work that I did was working with investors. So I've had quite an opportunity to spend time with investors. Besides that, the other thing that's part of my background and kind of a critical piece is the actual underwriting. So my education wise, it's in finance. So I did both an undergraduate and my graduate studies in finance. Um, I worked with a investment fund for about like a good year it was. And I spent most of my time underwriting businesses was what I had to do. So just kind of, diving into the nitty gritty of businesses and building out financial models and things for that. Um, and I took that experience essentially and decided to make a change and got into the commercial investment side of real estate. I think it was about like 2019, maybe 2020-ish, that I kind of started exploring this. And my team, Goya 7 Capital, we finally invested in our first deal as co-GPs. It was in 2020. I don't want to get my years all mixed up. 2020, was it 2023? What's 2024 now? March 2023. And that was 186 units out in Arizona. We also ended up investing in a 33 unit development property. Just this past year, we really didn't have much going on, to be quite frank. So we kind of shifted our strategy a little bit away from syndication, which I'm glad to kind of share here in a little bit, why we decided to kind of move away from syndicating deals. And in March, not March, May, we implemented kind of like our off-market lead generation strategy, and it's been working actually quite well. Over the past few months, we've generated about 45 plus off-market leads that we're actively working, and we've put out quite a few offers on those. Came very close on a few. And we have a small one right now that we're getting ready to close here, I think in 2 weeks, right now. And we also have two others, both 20 units and another 23 unit property that I think we're pretty close, getting under contract here soon. So that's kind of like, me in a nutshell.
Wow. So, are you still out of country?
Yeah, so actually I'm in China right now. So I'm in hotel.
Oh, okay.
I'm spending this week we're traveling and just kind of learning, about like some local cultures and kind of what China's doing on the technology side and just a bunch of really interesting things. So,
Right.
yeah.
So, well, I definitely want to say thank you for coming, and I also want to say I don't know if many of you have followed Dion. Dion had his own uh podcast, his own show, and it was a multifamily room investor was a multifamily investor room situation with Dion Huey. And I used to listen to that, believe it or not. I used to listen to Dion. And I used to always say to myself, man, I would like to meet that guy. Seriously. I was, like, wow, who is he? I would like to meet him. And look how the universe worked. It brought us
Oh, you got
together.
me sweating.
Yeah, it brought us together. And so I just want to say this is another dream of mine that has come true because we are actually we haven't done a deal together, but we have met you and we have worked together on the GOB. So that's definitely a blessing right there. That goes to show once you put something out into the universe, you better hold tight and be careful what you're putting out because it's definitely going to come to you. So let's get into this underwriting, right? Let's get into underwriting. Um, let's start out like this. I'm gonna start out first with Chris. Chris, what is your philosophy as to the importance of knowing how to underwrite?
It's the most important thing because then you're setting up your business for a foundation that, it, it, you're trying to take out all the unknowns as much as possible because the one thing that you're dealing with people, and that's the unknown. So, okay, so everything else you can try to take the unknowns out. So it starts with, due diligence. And when you're doing your due diligence on the property, right, it's real important because when you buy a distressed asset, you really want to know where your costs are going to be at all times. So you don't want
Right,
things to pop up because things that pop up, they're going to make you fail. So you want to try to expose all those during your due diligence. So what we do is we hire a team of contractors to scope the pipes, look at the electrical system, a roofer, a paver, a mason, a general contractor, a floor guy. So everybody that has specialties in these fields, right? So then we'll take the evidence that they find and then we'll go back and, put them into our model to make sure that the deal can work or not. So
right, right. And and Dion, what's your philosophy as to why it is so important to knowing how to underwrite a deal?
So, I really like this question, and I was actually thinking about this quite a bit. Oh, especially over the past few weeks that I knew we were going to do this. And I do agree with Chris. I think it's very, very important that we understand, underwriting. We understand the variables and things that affect, these models and how easily some of these things can be manipulated. I think that's very important. However, I think that as far as an individual really needing to know how to do all the underwriting themselves, I question whether or not that's absolutely needed versus having somebody on your team that knows how to do that. Someone that's already maybe, trusted, that's talented in that area that can do that, is just as easy as riding a bicycle, for them. Is my first thing. My second thing is the importance of underwriting throughout like this whole deal process. I used to think like, look, if you can't do the underwriting, you can't take the next step. And I would say that that was probably one of the biggest hurdles that our Goya 7 team faced over the past, 3 years, 2, 3 years that we've been together is we would spend so much time underwriting each and every single deal that we had come across our desk that it prevented us from moving forward. And there was always, someone or something that would come up and we're like, okay, yeah, we got to strike this down because of this or strike it down because of that. The numbers don't work here. Those numbers don't work there. Um, and we reached a point recently, and this is why we're gaining so much traction now. We reached a point where we're like, okay, we just threw all that stuff out the door. We got rid of all those complex models and things that we were putting together, and we simplified it. And we said, okay, this is what would make us want to move forward with a deal. And we looked for those things in the deal, and we figured out how we could make the deal work. We structured it in a way, we work out something with the owner where we could structure it in a way that we could hit the metrics that we need to actually make it a deal. And hence why we're under contract. We've had so many properties already that we should actually have a lot more, to be quite frank, under contract. There was one, she decided not to sell in the end, but um yeah, because of this different approach that we're taking. So, I mean, underwriting, I think it has its importance. I think it's even more important to be able to underwrite after you actually get the property under contract rather than wasting time up front trying to underwrite each and every single deal that comes across your desk, and then you end up missing out on other opportunities.
So you said a couple of things.
Mhm.
You said you wanted to throwing out all of the other stuff and implementing something new. That was one. But you also said that the underwriting and underwriting starting after you get it under contract. So let's hit that. Let's hit. I want to hit that first one, the first question, which is when you threw out all that other stuff and the team came back together, did you reform a whole? No. Did you have a criteria before, but when you threw out all that old stuff, you totally rebuilt, say, from the foundation, put in some strict criterias, and then you was able to move forward.
Yeah, so yeah, this is a loaded question. I figure out how I want to answer this. First things I think is and this kind of is the reason why we moved away from the syndication model, why we don't want to do syndications as Goya 7 anymore. We prefer to just do straight joint ventures, and
Yeah.
ultimately where it's like we can just own the property ourselves as a team. Is because with syndications, you have a very specified time period where you have to get out of the deal, right? And for us, we're spending all this time going out there looking for deals, and then you got to go and you got to do your due diligence. Afterwards, you get under contract, then you have to implement the business plan. And we don't want to have to keep repeating that over and over just to get to the next deal. We feel that's very transactional. And so our whole team, all eight of us, we voted that we would rather hold our properties as Goya 7, not via syndication model, and do it for, like a good 20, 30 year time horizon. So we've changed our time horizon. Um, so that's one very important variable, and we can talk about that here in a little bit. But as far as the criteria were concerned, I mean, yeah, I think it was pretty much what you generally see, like your typical IRR. We were looking to hit money multiples and things like that. We just threw all that stuff out the door, and we're like, okay, that's not really what's important to us. What we decided was important to us is, can we take, number one, can we take control of an asset that is producing a positive cash flow that's going to be worth our time and effort actually managing this thing on the day to day. That's basically what it was that we were looking for. Then we defined what would be valuable to us. Our minimum required cash on cash is what we expect is 10% minimum. In any deal, we want to earn at least an annual 10% cash on cash return. That was one metric that we set. And the other thing is we're like, okay, what would that look like, let's say on a per door basis? So we want to get about $200 a month per door is ideally what we want. Um, and then the other thing is that we cannot go into a deal where we're cash flow negative day one.
Mhm.
So that was the other thing. So that's kind of like how we kind of redefined our criteria. And so rather than us going out there trying to find a deal that fits these things, what
Right.
we do is we look at the deal and we say, how can we make it fit this way? Like, how do we have to put this together to where we can make it fit this? And then that's how we actually go and we negotiate with the sellers.
Wow. One of the things that you mentioned is a question that I asked. Since you have already stated your number, I'm going to jump ahead on my questions, and I'm going to ask Chris, because this particular question is what I've asked all the guests that come on this show. But Dion already gave his answer, so it wouldn't apply to him. He already gave his answer. So, Chris, I'm going to ask you this question. Let's say there was no such thing as an IRR. There was no such thing as a cash on cash. Let's say there was no such thing as an equity multiple. None of them things exist. None of them. None of them. We don't know nothing about it. But the one thing we do know, or the several things we do know, we know income, we know expense, and we know debt service. Looking at your cash flow, how much cash flow would you say would be sufficient, and you would consider to move forward with that particular deal?
Well, since we do the value adds deals very specifically, we want to have our costs in mind well before. And we would never ever buy an asset and then back into it and remodel it after you buy the asset, because that could potentially be devastating, right? So I'll give you an example. So we bought 506 South, but we knew we had to replace 2 water mains. Water mains are very, very expensive because you have to do one stretch. You can't fix it in one spot. You have to relay the whole new pipe from the street all the way to the deepest part of the property. So on average, that's about 150 to 200K per water main. And there was 2 that were broken that we found in our due diligence. So we got a 400,000 price reduction off of the seller. So now we knew that beforehand. Now, if we figured that out afterward, we would have to bite it and eat it. Now that's you would have had to have a capital call then. So that's why it's important to know all your costs well ahead before you close on the property. So
Okay. But what would be your answer though, to that?
Oh, okay.
What would be your answer to that question? Because you're still gonna do your thing. You still got your costs. You still got all of that. You still have all of that. Right. But you have your income, you have your expense, you have your debt service.
and,
There's a cash flow.
well,
Is
then
there minimum cash flow that you will accept?
it's going to depend upon what kind of value add strategy you're going to
There you go.
go in.
Okay.
So like, how much renovation are you going to have to do? How much, are you going to have to redo the outside? Are you going to have to paint everything? The buildings are, we deal in 100 units or more. So let's say you have to paint a complex. So that's going to, on the short, be around 250,000, right? So, and then, what kinds of renovations are you going to do? So we want to know what the price per door is going to be on the renovation side. It's going to be, 15K. Are you going to do granite? Are you going to do, a different style of stone for the countertops? What do the microwaves look like? What do the backsplashes look like? You have to figure out all that other stuff. So it's not, you can do a quick back of the math like you're trying to do, but that's not our strategy. Our strategy is to know exactly what our costs are down to the penny, because there are going to be things that come up. And so we always have enough net operating income in the bank. So when those things come up, we'll be okay and not have to, do a capital call with our investors.
Right. And you do syndications, am I correct?
We do, yeah.
Yeah. Okay. Cool, cool, cool. So
Daryl,
this is
can I add something
so
there?
sure, sure. Go ahead, jump in.
I mean, I again, like what Chris just said, I agree totally with that. I wanted to clarify what I mean is you don't, it's not saying you don't, we just don't completely do any underwriting. We really do the underwriting after we get under contract because the thing is, it's like you're competing with so many people, right? And what we found, and for our particular case, is we need to be the first to get control of the property. And so we really, we have our little, strategy and our back of the envelope thing that we do. And I mean, it's working for us so far and allows us to take control of the property quickly.
Mm,
Now, when we do find out there are issues and things through due diligence, then we will go back and renegotiate with the seller. And we always make it to where we can walk away from the deal. We don't commit any money going hard
right.
until after our due diligence is complete. Also, as far as us for like deal size and everything, we're usually 50 units and under is what we're looking at. So we're not like Chris, I think you're probably what, like 100 plus, you typically speaking. Yeah, so I mean it's I still think they're two completely different
Mhm.
playing fields, if you will.
Yeah.
Yeah.
And that's what I was
And
going to say.
you're dealing with a different type of owner too. Yeah.
Remember, listen, everyone, we're here for education. We're not here trying to compete. That's not how I run my show. This here platform is about education. You're learning something. You, in commercial multifamily, there are so many strategies and niches and ways to do things. Listen, how many people have I had on this show? Everyone have their own way. They have their own niche, right? But learn from it. Take something from it. Ask questions from what you're hearing, right? That's what you do. Chris is in value add, right? And he has a strategy. He has his strategy. Dion has his strategy. What can you learn from these two people? What can you learn from them? Because they're dropping nuggets. I don't know if y'all realize it, but they're dropping nuggets. So,
We had to change our strategy because I mean it wasn't working. It really wasn't
yeah,
working. Our original strategy, it was really tough to find anything that made sense. And we were looking in Atlanta because we've got Ray down there. We were
yeah,
looking in Columbus. We were looking in a few different markets, trying to find things that made sense. And those were in like the bigger units and things like that. But it was just like we were competing with all these other guys that were pretty well capitalized. And I mean, it's just like it was just too tough. And we was like, okay, either we're gonna try to keep moving on along this
right.
path, and maybe we might hit something here in a couple years, but no, we decided to move away from that for us. And it works for us so far. Yeah.
Yeah.
So yeah.
So, well, that's going to lead me into this question right here, right? And this is going to be for the both of you. Our economy has gone through so many changes. I mean, constantly, interest rates, um, you know, whatever else. A lot. I've seen a lot of foreclosures coming across. Um, you know, well-known investors having to give back their properties. With that being said, to Chris and Dion, have you had to alter your way of looking at things so that you could continue to move forward and acquire assets, right? Go ahead, Chris, take that.
Uh, we, we've added more to our reserves. Um, we used to do like 3 to 5 months of net operating income in our accounts, and now we go up to like 8 months. So
That's, something now. I always I didn't take my NOI. That's really good. What I usually take is the expenses and the debt. I will put that as my emergency reserve. That's very good. I never thought about that. But so why the oh well more money, of course. NOI. Okay, okay, cool. I dig with that's cool. All right, Dion, how about you?
After the rate hikes, that we experienced, that is probably one of the main catalysts why we decided we needed to change our strategy completely and our whole way of looking and approaching it is because we weren't finding anything. Even when rates were lower, it was difficult because everything was being bid up. There was one property we put a bid out on, and it ended up like somebody else came in and paid 1 million over, what was asking. We're like, we couldn't do that, and we were like, how do those numbers work? You know, um, but with the rate hikes and everything, so with our strategy and how we're approaching it, we don't care. The rates could be 15 whatever percent. I don't care. We don't care.
Right,
Because again, we go back and we will try to figure out how to make the deal. How can we put it all together to where we can make it work as long as we can
right,
hit those metrics. That's it. So I mean, rates can be, 3%, rates can be 12%. It doesn't matter. We have the
right.
one deal we're getting ready to close. Our private money rate on that, I think, is about 12%. So what? Doesn't matter to us, because we can still hit the numbers that we need to hit. And we already have our plan in place on how we're going to go ahead and get that refied out within the time
Mhm.
frame that we need to get it refied out. So
So really
yeah,
for
we
your
just
strategy, so for your strategy, it's not about it's more about terms. Am I correct?
exactly. We focus on
And
the terms and how we can
focus
structure
on the
the deal to
terms.
make it make sense. Yep.
There you go. It's more
Yeah,
about terms.
because the deal there, because I mean, if everybody is just waiting for a deal to appear, I don't think it's ever going to appear, to be honest. I mean, you really do have to structure. I mean, it just reminds me when I was working in real estate brokerage in New York City. I mean, I've worked with some very talented business people, and I mean, never did I have any of those older guys talk about like underwriting. I present a deal to them, and literally in like 2 minutes, they're like, "This is my price. That's it." And I mean, it was like they already knew. They knew exactly what they'd be willing to pay. All I had to do was tell them what the gross potential rent is on the
Yeah,
property, and and they knew, and they had their strategy. From there, it was just like, okay, this is how we can structure the deal so that it makes sense.
yeah. A lot of the guests that I've had on the show, when I asked them that question about taking away the IRR and all of that other stuff,
Mhm.
um, I always hear the story of, back in the day, the older, they would call them the OGs back then. They would look at the deal and they knew just by looking at it, yo, this is no good. Just by looking at it. They didn't know nothing. They didn't even ask about no IRR. They didn't ask about equity money. They didn't ask about none of that kind of stuff. But they were like, yo, let me take a look. Nah, man, that ain't no good. Because they knew what they knew that they saw the cash flow. And the cash flow played the big part. And they said, no, this isn't going to be a good cash flow deal. So yeah, I can definitely understand that. And I guess that's where I'm gonna have to, I'm gonna have to also get better uh myself. And because I consider myself a very good underwriter, but I think I'm going to have to also change the way I look at things and the way I handle underwriting. Underwriting is very important for you to know. Without knowing the valuation or how to value property, you can never get no money. If you can't explain your underwriting, you can't explain how to get that capital. I have a coaching program and we talk about underwriting. I teach underwriting, the importance of underwriting, why you need to know underwriting, what's involved with underwriting. If you want to learn more about underwriting, join my coaching program. My information will be below.
If I could just add, to that as well, just
Sure.
because all this was really eye-opening for me. You know, as like I said, I studied finance. That's what I studied, and I worked with an investment company and things like that, and it's just always so used to diving into the models and things.
Yeah.
Um, and part of it, what changed my mind is, like I explained, the experience that we had with Goya 7, trying to find deals and really just not getting any traction that we wanted. But then the other thing was what was really surprising to me. Two things happened, and one of them recently. The first thing was not too long ago. It's a guy that I know, and he came to me. He was like, "Hey, can you teach me financial modeling?" I'm like, "What for?" Because he went to go work for an IPO uh, investment bank here in China. All they do is specialize in IPOs.
Right.
And finally, he got the job, and he went over and started working. And he was like, I can't believe that these guys are making this much money. And he was like, and the wildest thing is they don't do any modeling. And I was like, what do you mean? It's like, well, how do they project out things? How do they come, arrive at the pricing for the companies and things like that? And he was like, because they already know how much they need to make profit, for every single deal. And then that's just how they stipulate the terms that way. And then they'll work with the company to make the terms work. And that's all they do, here. Another one recently, a buddy of mine here, he approached me like was it about a month ago, 2 months ago. He has this real estate investment project here in China. And he was like, I'm looking to raise XYZ amount of funds. And I'm like, okay, so like, what are the returns? What can you show me? And he was like, listen, all you need to tell me is how much money you need back and the timeline you need it back. And, we'll see whether or not the project can support that. And I'll make sure you get that back. So it's a completely different,
Yeah, it's a completely
you know,
different way of looking at it. Yeah.
completely. And I asked him, I was like, well, wait a minute. And he was like, no, 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 stop there. He's like, this is how things are done. Because we already have control of the resource. We have control of the property. We have all the permits from the government and everything else is already in place. We have people lined up that's going to come in, that's going to buy and do XYZ. We just need to close this gap here. So you
Okay.
just tell me what it is you want, and that's it. So I mean, it's a completely different
Yeah.
mindset I'm finding, so
Cool. Cool.
Yep.
Let's jump into, because we have just a few more minutes. We have, I mean, I say a few more minutes, but we got a couple more minutes. But I want to jump into, I want to jump into the rent roll. I want to jump into the T12 because those documents are important. Um, and regardless of whenever, right? Whenever you underwrite, whether before or after, you got to have the T12 and the rent roll. Okay. So normally what I would do, I would put a sample T12 up, but I'm not going to do that. I just want to hear, and everybody take note, right? Take note. And Chris and Dion, when you're looking at that T12, what what are you looking for? What are you listening? I'm going to say two ways. What are you looking for? And what are you listening for? Okay. What are you looking for? And what are you listening for? Chris?
It's important to know all your costs, right? So you can look at your T12s and then you compare it to their bank accounts and you can see if the seller is being creative with the numbers and not being truthful, right? So because we've seen a lot of deals where, they say one thing and then you get the books and they're not as they said. So you really want to know your hard costs. It's very important to know, some of your basics, what are your electric, what are your water, water, sewer, et cetera, security, how much, so then you can create your NOI. So it's really important to know the numbers. So your T12s will be, a clear indication of, your costs to see if you can break down the deal to make money.
Oops, sounds good. Okay, okay. And Dion, same question for you. What are you looking for, and what are you listening for?
Yeah, pretty much the same, like what Chris said when looking at the T12. You want to see, um where it is maybe like the existing owner, they could be operating very inefficiently. Like a lot of the, for example, some of the T12s I've seen, there are some where it's like the numbers just don't make any sense whatsoever. There was one I saw, it was maybe what, like a month or two ago,
Yeah.
and just overall their OpEx as a percent of their rental revenue, and they were, I think, 94, 95% occupied. It was like 17%. And it's like, how are you guys at only 17% OpEx? You know, it just didn't make sense. I mean, eventually I realized, well, number one, they were self-managing, and then number two, they were skimping on a lot of things that they were doing. So, so yeah, you definitely want to see, what is they're doing. There was another one I saw too, where there was like this large management fee. Come to find out, they were paying that to, I think it was like their daughter or somebody, on the property. Yeah, to
Mm,
basically essentially manage the property or whatever she was doing. So just looking at some of these things, to determine, just how realistic it is as far as like, how efficient they're operating it. Can you do it better? Um, Yeah, and another thing too, actually, one was really interesting, that wasn't actually real estate related, but this happened to me a couple years ago. And I always like to share this story with people. So we were looking at acquiring, it was a chain of restaurants in the northeastern region, like New England area.
yeah.
And I was putting together this financial model for a leverage buyout of it, which is essentially using debt to buy a company. And I was looking at the expenses and going through everything. Their T12 essentially is what it was. And the numbers didn't make sense to me. It just, something didn't sit right. Because I was comparing that to industry standard, et cetera. Um, Come to find out, as I dug deeper, um, I realized the problem was with the salaries that he was paying. So his salaries, for having, it was like a couple hundred employees, his salaries were probably, it was like what, about 100,000 a year at that time, which made zero sense to me whatsoever. I did some digging and come to find out he was hiring a bunch of illegal workers.
Ah,
Yep. He had a lot of illegal workers, in his firm. So I mean, it's, you really want to make sure you know what it is that you're getting into. I mean, for us to
right.
actually go into that type of a deal expecting, yeah, this is probably where, our salaries might be, we might be able to achieve the same thing. Well, we'd be doing something illegal going in, to that, and it's
Correct.
definitely not realistic. So,
Right.
yeah, yeah.
You know something? Um, I was looking at a T12, and I want you and Chris to tell me if I should or should not have done this. But I was looking at the T12, and I look, and again, just like what Dion said, the numbers were like, I, everyone, when you get that T12, you have to you have to become a forensic scientist, a forensic underwriter. Let me call it that, because you really got to look at it. So as I'm looking at the um expense, I'm going down, and I'm at repair and maintenance, and I look straight across, and I said, "Whoa!" I said, "Why?" I said, "Why is, say, $5,000 in this one particular month, right?" And it was, I said, and then I'm looking at the rest, the other remaining months, and I said, "I bet you any amount of money that that 5,000 is an AC unit that was put in, which is a capex, and it shouldn't be there." And then I was also looking at, there was a few more things that I had to pull out of where he had it, and I and both of them was they had to go below the NOIs, right? So that right there changed, just about changed everything. So when I did that, my question here is, I did pull out that 5,000, and it brought the repair and maintenance right in line with all the rest of the 11 months. I said, okay, that's a capex, that's an HVAC. Let me put that down here. And then the rest of the I think it was he had. Well, of course, we all know debt service doesn't go above the NOI. Okay, so he had the debt service above the NOI. I pulled that out and I put that below the NOI. And I think he had one other thing that doesn't go above the NOI, went below the NOI, which I had to pull that out and had to put that down below the NOI. Then I finished my underwrite, and when I looked at my what I can offer, it I was like, yo, this here is a good deal. I want to jump on this real fast. So I put his numbers into the model, right? After I made the edited version, then I put the numbers and his numbers, my numbers, and everything. But do you think I should have or should not have done that? Who want to take that one first?
I would have to look at everything did you do the deal or?
So right now, I'm trying to. The only thing I have to get is the tax information and the insurances. I mean, insurances. Oh boy, tax information and the insurance. I definitely want to move forward on this deal because after making those adjustments, the what I can offer him, it won't be exactly what he wants. It'll just be like a tad bit less. But I believe it could get a conversation started.
Well, you always make money on the buy, so you got to make sure that you're not going to get sunk. So I'd really have to look at all the numbers and see it myself. So
Gotcha. Okay. Cool. Cool. All right. And Dion, how you feel about that?
I mean, my thoughts are because I mean, again, coming with that finance background and things, it's pretty normal for us to reclassify things where we see that they're supposed to be, we're supposed to fit, what goes above the line, what goes below the line, and things like that. Um, I probably would have taken a very similar approach because I mean, putting something in like that, that's not, installing new HVAC, system units and AC units, and that's not like regular
Mm-hmm.
operational things. So I mean, even according to accounting standards and things, you don't put that, in your regular OpEx, right? That's supposed to be a
Right.
capital expenditure thing. So, um, I probably would have done something very, very similar. I think one of the things I just wanted to just to share, I guess, just from like an overall underwriting thing, and one of the things that we really like to dive deeper into are the rent roll. And we
Mm-hmm.
really like to look at the bank statements, and the bank statements and leases and these things. And we
Okay.
like to compare, these numbers, so that way we really know what it is that we're acquiring. There was one, so on the one that we're actually getting ready to buy, so we're going through everything. We look at the lease, get the copy of the bank statements, and then we find out, well, wait a minute, you have this listed as though like she's paid according to the rent roll, but
Right.
then you send us a message saying that she's actually late. And she's been late, she's behind, I think, because there's no corresponding deposit, right? So she's
Right.
behind by, I think, is what, like 3 weeks or something like that. You know, so as far as like our underwriting and thing is are concerned, I mean, that's when we really start to dive into, like, once we get the property under contract, that's when we really dig deep. And then, at that point, because, like Chris said, you want to know what you're getting into, right? You want to
Yeah.
know what your costs are going to be. You want to know what to expect. And then at that point is when we actually go back and renegotiate with the seller. So we actually did. There were a couple of things that we found out, and we did go back and we renegotiated with him, and actually it turned out even better for us because what we ended up renegotiating are better terms. So we
Gotcha.
didn't actually change much via price, but we got better terms, much better terms,
Right.
on the
Gotcha.
renegotiation. So yeah.
Cool. So my co-host, I got to let my co-host get in here. Otherwise, she gonna beat me up. So
Alicia, you're muted.
so
I'm
Long
not
time no
gonna
see.
beat you up.
so so
The-
so Alicia, go ahead with your
yeah,
go ahead with your questions.
these questions have been so good, and the answers and responses have been amazing.
Yeah.
And it's great to see you both, Chris and Dion. And Dion, it's great to see you live.
It's been a
um,
while since we've seen each other.
yeah, it has been. So I have to go through my notes, and I've like been crossing them off because you've been answering them. But how how are you managing 15 units and under, especially since you're in multiple states?
Who's this for? Chris or me?
Dion,
Mm-hmm.
because Chris
Yeah.
does the higher units, right?
Mm-hmm. Mm-hmm.
Yeah.
Yeah.
So
Yeah. Mm-hmm.
15 and under units is what you said is your focus,
50.
right?
50 and
50.
under. 50 and
Oh,
under.
okay,
Yeah.
50.
50 and under. Yeah.
So how are
50.
you
Yeah.
managing those in multiple states?
Mhm. So what we did, our original strategy was just kind of like, hey, let's go find the deals where they are in markets that we have boots on the ground.
Uh-huh.
But we changed that and we are solely focused on Ohio right now. So mainly Columbus, Dayton, and Cincinnati. And that's because we already have a network there. So we have two of our partners that have, between the two of them, I think they've got about like 40 some units in combined in these areas. And already have property managers, already have, they both have crews, so renovation crews and people that, they could call up today and they'll be out there, this afternoon or whatnot. So that's basically how we're able to manage that at this point. And so we're kind of just concentrating our buying efforts in these geographic areas. So that way, we could come closer to more, I guess, scale economies, if you will, as far as costs are concerned.
Okay.
So yeah.
Yeah, I totally
Mhm.
understand that. And then, Chris, you have properties in multiple states, right?
Correct. Yeah.
So, how have you been able to leverage the management of those properties?
Well, we do, third party management. So we use, uh, our firm that to run our apartments on the boots on the ground, so to speak. So
Are
Asset
you
Living is who we use. We've had really good luck with them.
okay?
JC and his team have been really, really good. So eventually when we get big enough, we'll take everything in house, but we're just not there yet. So,
Okay, so I said they're in multiple states, though, right?
oh yeah, they're
Yeah.
I think they're one of the biggest ones. They just merged with another company, so they're really big. So
Yeah.
Okay.
Asset living is eating up property management companies.
Mm-hmm.
Yeah.
They are. They are. Um, with Dion, when you say non-complex model, when you initially look at the properties, and you talked about if the terms look right. So if you're when you're looking at, let's just say, a 50 unit property, and these units are in a very growing market, the units are being sold at maybe 200,000 per unit. Where do you need to be at a purchase price if the rent is, let's just say, 1,500 um, for one bedroom, one bath, 1,700? No, that's probably too low. 1,800 for a two bedroom, two bath.
So we Because a lot of our team, we're like either we've got a couple guys, we're realtors, including myself, and others investors, uh, singles, doubles, triples, whatnot. We just follow a very, very simple rule. We're like, okay, let's just go back to the basics, our block and tackle framework, and we generally stick with the 1% rule. As far as, let's say, like, you have that typical 1% rule, so 1% of like whatever your monthly combined rents and things are, and so that's like the very first thing that we look at. Okay, this is what they're asking. This is how much they're receiving in the rent. Okay, this is kind of very, very rough, what it might be worth, right? So we look at that, and then we go back and we have a conversation with the seller to try and uncover, what is their real motivation for selling? How much flexibility do we have potentially with them? And then we figure out, okay, if they're very, just intent on getting whatever it is that their price is, okay, how can we actually go and renegotiate this to where we can give them what they want, but we also get what we want as well? And that's kind of like our starting point in how we approach this,
Hey guys,
So
unfortunately,
like,
I have another meeting. I got to
Yeah.
run. So,
Okay. Yeah, I was just
thanks,
going to send
Chris.
you a message. I said you got great. So I want to thank you for coming, for being here,
Mhm.
Chris. Thank you very much. All right.
sure. Thank you, Daryl. Thank you,
All right.
everybody. Have a
All right.
great
I'll have
day.
you back here.
Hey, Chris. Yeah,
No
Okay.
problem. Bye bye. Great to see you,
All right.
Dion.
you too.
Bye.
So like a great example, I think was, so we were looking at, there was this, it was, how many units was, I think it was 31 or 32 units. It's in Cincinnati. And a lot of the properties we've been targeting are those that have been owned for like a long period. And so like this one, they had owned it since I think it was like 1996 or something like that.
Mhm.
And they're looking at retiring. They essentially own the property debt free. And we just throughout conversation with them, they basically said, "Hey, look, what it is that we want is we want to go and buy a farm and then just live off the farming income." And we're just and so they wanted to roll the money over via like a 1031. And we're like, well, if we could show you another way to basically kind of defer those capital gains and you could still get income, your retirement income, and not have to actually go out and look for another. Would that make sense at all to you? And so
Right.
they were open to that discussion. And what we did was we put together a deal that made sense and could get them what they wanted, even at their asking price that they wanted. We thought the asking price, it was okay. It wasn't too bad, but yeah, we were very, very close with them on a deal for that. And I'll be honest with you, the reason why we didn't actually get that under contract was because one of my teammates dropped the ball. So he dropped the ball on the follow-up was the problem. The follow-up, we were
Right.
literally, no lie, we were literally, I think, like a few hours late on the follow-up. A
Wow.
few hours late. Yep.
So, and that killed
Yeah.
that one.
Yep, because we had
Wow.
already given them an LOI. They replied and they were just like, okay, we're not interested in this, but what else can we do? And we had already come up with another scenario that we thought could work. And unfortunately, we were a couple hours late. So,
Yeah. The strategy that you're using, and it's almost it's up. It's 12 o'clock. Um, I got to be respectful of your time. So what I'm going to say is, I want to have you back. I want to bring you back to continue this because the information that you have been sharing with the listener, this is priceless, and it gives a whole new way, a whole new way to look at things. And to be honest, I remember um, when I went through my boot camp, um, commercial multifamily boot camp training. They spoke a lot of they spoke a lot of terms. He spoke a lot of terms, a lot of terms, a lot of terms. But when I came out of boot camp, it wasn't when I came out of boot camp. I didn't stick to that same concept of terms. It was like what took over was what's being done, actually being done now. But I like that. I like the fact. I like what you're doing, and I definitely would like to have you back to talk about underwriting some more and break into talk well, we could probably dig a little deeper into the T12, dig a little deeper into the rent roll and stuff like that, and talk about the OM, because these are things that are, to me, that's very important. And you don't have to be a specialist in underwriting, but you should at least know the basic foundation to underwriting. Okay. So that way you can just, so that way you could go out and explain the underwriting, right? You don't have to call Dion or whoever is on your team and say, hey, can you come over here and explain this here? Right. So at least know the basic foundation. Okay. So, but Dion, I want to thank you for coming, man. It was fantastic. This
Can I
here,
say one thing in closing
sure, sure, of
as
course.
well? I think the biggest takeaway I hope everybody I can share with everyone, tonight is don't let underwriting prevent you from doing your deal. And the reason why I say that again is because like our team, we were literally spinning our wheels for like a couple of
Mhm.
years. And then finally it was like this year, it just something clicked. And we were just like, this is what we were doing before. We were just too focused on the underwriting and nothing was making sense at all. We weren't getting the traction that we wanted. And then when we shifted that mindset, it's just like things just started falling in place. Yeah.
Oh, wow. That is That's fantastic. Dion, do you still have your podcast?
I mean, it's still out there, but I don't have time to do the interviews and things. Yeah. So,
Yeah. Oh, I saw it out there. I got it. Listen,
Mhm.
everyone. If you want to listen, please hold on a minute. Let me share. Because I'm gonna tell you. Let me see if I can. Where is it? Right here. Dion Huey, and here it is. And I remember, man, I used to listen to Dion. I'll be driving, and I'm listening to Dion, and now I'm interviewing him. And wow, this is definitely my dream right here.
Yeah,
So,
I interviewed about 150 investors, mostly syndicators,
mhm,
on that podcast. So there's still quite a few episodes that I haven't actually published as well. Um, but to be quite honest with you, I've yet to hear one person kind of approach this whole idea of like underwriting as far as commercial
yeah,
multifamily
mhm,
with this same type of mentality, to be totally honest. And I'm just speaking just from me interviewing the people that I've interviewed.
right,
Yep.
right.
Yeah.
Well, now, do you have a coaching program?
No, I don't.
uh, no coaching program.
No,
Is,
no, no.
if somebody would like to just reach out to you, how could they reach out to you?
Hmm. Yeah, feel free to just shoot me an email or something. It's my first name, Dion, at Goya, Goya number 7 capital.com. You can reach me.
There it is. Yeah, and I
Hmm.
want to thank you very much for coming, and thank you for sharing with us another perspective, another way of being able to acquire assets. Now, I'm gonna be honest with you. Text Alicia and said, Alicia, I think we should take a look at this because we've been underwriting. Matter of fact, I don't know if you recall, we did the acquisition summit in Phoenix several years ago. That and right after that's like the market just started going bad, and we've been underwriting deals, and these it's just not working out. And last year was not a good year. And so far this year, like it's about like the same. So I definitely want to thank you for coming. You dropped some platinum on us. We didn't go gold on this. You dropped platinum nuggets here.
Let's get together, like our Goya team and you guys. Let's chat. We can talk.
I would like to do that. Definitely will. Definitely
Yep.
will. So, Dion, thank you very much for coming. I want to have you back. I'm going to get with you to have you come back. And everyone, Dion's email is in the chat, but this video will also be released today, no later than tomorrow. I know I've been running a little bit behind, but it will be released so that you can review it. All right, and so forth. But thank you all for coming, and I'll see everyone back here. Jerome, if you could stick around after I end this, I appreciate it. But we'll be back here on November 12th with our next guest speaker and her and her team, and hopefully we can share some more nuggets. But Dion, thank you very much. What time is it in China?
12:07 a.m. right now.
Oh man, I know you can ready to hit the bed. So so listen, thank you very much, Dion. Thank you for your time. And I want to just say it's a blessing to have you here. Thank you.
Thank you. I really appreciate it.
All right. Thank you everyone for coming. See you in 2 weeks.